Hi, this is Carla with the Minnesota Bankers Association with a brand new Minnesota Banking Minute. Today, I'm joined by Meg Tweedy with RLR Management Consultants, and we're going to talk about loss prevention, certainly a topic that is on the top of everyone's mind. Welcome, Meg. So, Meg, tell
Hi.
me, bankers, while they're vigilant about external theft, they often overlook the fact that the most significant losses actually result from internal control failures. Can you elaborate on that?
Absolutely. So the contributing factors often point to the exceptions, such as allowing verbal approval of a wire that a client is too busy to confirm. It's really textbook. The account officer knows the client plays golf on Wednesday or they're in Hawaii on vacation, so they prove the exception. But you know who else knows the client's out of town? The client's employees and anyone who's hacked their email and their calendar. The significant losses tend to be traced back to these exceptions, and they're innocent enough. The account officer didn't intend to facilitate the fraud, but they're allowed to make these exceptions, and the banks need to consider what types of exceptions are allowed. In some cases, an account officer might offer to call the client and sign evidence of the call. It's my experience, though, that it's not always clear whether the call actually took place. However, it's a crucial piece of information to understand that if the fraud case is significant enough for the bank to file an insurance claim, the insurance company will request the phone records to verify the call. Not just the banker, but they'll subpoena the client's records as well.
Oh,
So this should
wow.
make us all pause and ponder the possible implications of not following proper procedures.
So the operations team is responsible for reviewing client activity and are the front line for fraud prevention. But as you said, recent losses have been traced back to treasury management exceptions, processes that were under the radar. What risks come from that area?
Oh my gosh. I recently worked on a case where the treasury management team implemented virtual cash vault setup with a major armored car carrier. No limit was placed on the amount of the cash the client could order at any given time, nor any monthly limits. The client was a check cashing business and hired an employee who decided to commit fraud. The employee increased the cash orders from 30,000 a week to 150,000 a week and began cashing third-party tax refund checks. The error was compounded when the compliance team missed the increases in the activity. The bank was alerted to the fraud only when the first affidavit of forged endorsement was received, and by then the bank was facing a $1.2 million loss. The reason there were no limits in place on the size of the cash orders the client could place is because the client contracts directly with the armored car carrier and not the bank. However, the bank can certainly add a dollar limit to their treasury management agreement, and certainly the BSE team needs to be aware of these limits so they can spot the exceptions.
That's a crazy story,
I
but
could go
true.
deeper on
I
that
don't
rabbit
doubt it
hole.
at all. It's amazing the things
Yeah.
that are happening, you know. Our community banks, they pride themselves on excellent service. And one thing that, a community bank sells is the fact that account officers can often waive things for their clients. So what type of waivers or special services would you recommend they avoid?
Well, clients with large cash deposits often don't want armored car service to their location for fear of attracting attention, so the cash is directed to the branches. Yet all this does is move the risk to the bank. These activities should be constantly reviewed and approved by the director of operations or the chief risk officer to ensure the bank is willing to be the one with the increased risk. Set up on-site cash machines to minimize the armored car activity. Waive the fee if necessary. Um, Moving on to the next reason is never allow someone not responsible for a department to approve a waiver to the actual processes and approve one-offs that fall outside normal operating procedures. This is the exception handling, and these things are the things that go south with losses or conversions, or when one trusted employee who could do the work with their eyes closed has an emergency and isn't there to handle the work. All waivers should be escalated to the department head for review and approval. Be cautious of new deals that require special handling and make sure that the teams work through it before the customer comes on, just to make sure that this is something the bank can actually do. And then always be cautious with requests to manage things like escrow accounts or arrangements where the client is asking the bank to be party to review transactions or sign on accounts. If things go south, these things often come our way when the client is looking to pass liability to someone else. They assume the bank has the deep pocket. So always look for the complicated things. If you don't understand it well, perhaps the client needs to go to another bank. And yes, we all want to jump through the hoops to try and find that solution. And if you can, that's amazing, but don't be pressured into doing something that you're not equipped to handle.
That's a really good, that last line I think is the most important, because we do often, we don't want to let customers tell us how to do our jobs necessarily.
Yeah, no, that's
Tell me,
right.
what data should the bank be reviewing to help detect anomalies that could indicate fraud?
Oh my gosh. The client activity trends are such a source of information that can quickly shed light on areas that are on the verge of causing a problem. For example, if a client suddenly has increased wire activity or ACH, make sure the trends are being reviewed and someone is questioning the activity. Banks often overlook the value of examining the bank's account analysis summaries. These systems typically provide the ability to pull month-end summaries that allow you to spot trends. Ensure you have a report that will enable you to spot the product trends. And this one is a big one for me. I was with a financial institution that had normal ACH wire activity for a client that suddenly skyrocketed. And we saw the trends. In hindsight, we would have acted even faster, but it was an indication of giant fraud being perpetuated by the client and put the bank in a very precarious situation that ended up jeopardizing their upcoming merger.
Wow. Okay. So how often do you recommend a user access review?
Oh my gosh. Well, first of all, you've got to prioritize them, but I would say for your high risk ones, absolutely quarterly. Anything that's related to a correspondent banking relationship, Abrigo, some of those other systems, Equifax, some of them, they just don't get looked at. So you really need to take the time to identify what applications the employees have set up. And this is especially critical in community banks because sometimes when they're small, and we see this a lot in the de novos where everybody is working really hard to set up systems, and people will go in and set up access to systems and they're the only ones that know they have it. But then it becomes something that the bank is really relying on, and there might be data in there that's necessary. And I saw an instance with one community bank where the loan operations team had 7 applications that they were using that were not documented with the IT department. They had staff turnover, and when the last guy finally got fed up one day and threw his keys on the desk and walked out, that bank was locked out of all of those systems for several weeks. So you want to make sure not only that you know what your employees are doing, but you want to make sure who has access, who are the administrators, what are the rights below that. And the other thing that people hardly ever think about is what's your cross-channel exposure with those applications? Have you allowed somebody to, you've got a director of operations in a small company, so they can order cash, they can run a cash drawer, they can board new accounts, they can board online banking, they can approve wires. Look at all of the different systems and compare them, make a matrix for each employee to figure out where their access is and review what that looks like. You don't want somebody that can go in and if they were going to commit fraud, they could create an account on a customer and follow that through by emptying out someone's bank account. The other side of that is, we see these individuals who are the trustworthy. They've been with the bank a billion years. They know everything. You're friends with them. You trust them with your life. But what if they make a mistake and they have too much access and they cause a regulatory issue or there's a loss? You have now put that employee in jeopardy. And I just really believe that we have a responsibility, not just to protect the bank from the loss, but protect your employees and make sure that their integrity is never questioned and that they're never put in a place where they have to defend themselves.
That's an excellent point, and you have given us so much to think about. Meg, you mentioned before we started recording that people weren't going to sleep at night after this, and I think I'm not even a banker, and I don't think I want to sleep at night now. So, thank you
it's
so much.
Crazy. All right, thank you.
Yeah, thanks for joining us, and for more information, contact RLR Management Consultants. And thank you for joining us on this newest Minnesota Banking Minute.